one other thing I'll say about that I think is kind of interesting. The fact that the Federal Reserve is a bank regulator, but the Federal Reserve is owned by the banks. I'm just going to throw that out there. I'll leave it right there. So I've been in the business. I've been doing this for 25 years, and it's hard for me to imagine that it's been 25 years, but that's where all the gray hair comes from. But I have managed investment portfolios across sectors, and including multi-billion-dollar portfolios across fixed income, foreign currency, alternatives, equities, and borrowings. The Federal Reserve is the bank that banks use, is the easiest way to think about it. So they are the banker's bank, meaning that every commercial bank in the country has an account with the Federal Reserve. And the Federal Reserve facilitates payments across the Federal Reserve system. It also is a store of value. So each bank has to have its own checking account, so to speak, or a deposit account at the Federal Reserve that they earn interest on. And they can borrow from the Federal Reserve. So it is truly like a bank to banks. The first Bank of the United States was formed in 1791, and it was created it was actually the brainchild of Alexander Hamilton, who is our very first Treasury Secretary. It was set up to manage currency and also manage the debt that as a country we accumulated from the Revolutionary War. The downside is that it was only chartered with a 20-year term, meaning that it would have to come up for renewal in 20 years. So in 1811, when the first Bank of the United States charter came up for renewal, there was massive pushback against renewing its charter. Mainly it was a populist movement, and they didn't, the congressman at the time didn't want to, centralize the economic power of the country into one institution. So they didn't renew the charter. Then the War of 1812 happened. So almost 1 year later, the War of 1812 happens. So in 1816, I believe, it was determined we need a central bank. So they created the second Bank of the United States, and it operated for a period of 20 years. But then Andrew Jackson, when he was elected, he was highly against this, the second Bank of the United States. And so he, along with several others within the government, vetoed, renewing that charter. So the U.S. economy operated for a period of like 80 years without a central bank. So what this created was sort of the Wild West of banking. Essentially, each state had the ability to charter its own banks. And so you could go to your state banking regulator, I'm not even sure what they were called at the time, and you could get a charter to start a bank. And so there was all these small banks that were popping up all over the country. But the difficulty is we didn't have a central currency. So we didn't have so each bank would have to create its own banknotes, which is a form of currency. And those banknotes were valued based on the perception of the financial health of that bank. So if you're in a local town and you've got a banknote from your local bank, you could probably use it with the merchants in your hometown. But if you were in Ohio, as an example, and you want to cross the border into Kentucky and you try to use those banknotes, well, the merchants there didn't know the value or the perceived health of that bank. And so there became this situation where you had rival banks all creating their own currency, and nobody really knew how to value them. And it also led to several bank panics, including boom and bust cycles. And so in 1907, there was a pretty major recession. There were several banks that failed across the country. And so there's no central bank, there's no, lender of last resort. And so there was a group of bankers and industrialists who gathered together on the behest of J.P. Morgan himself, like the J.P. Morgan. He organized this group, and everybody pitched in money, and they went and bailed out some of the banks. So they had to infuse them with capital. So this exposed, the panic of 1907 exposed the need to create a central bank. Again, to manage currency, manage payments across the system, being the lender of last resort and a bank regulator. I think that the thing that most people get wrong about the Fed is a lot of the conspiracy theories that surround the Fed. You know, the Fed is one of those organizations that, because they're secretive, but they're secretive for a reason, right? They're more or less confidential. But people view that confidentiality as, an indication that there's something nefarious going on behind the scenes. But truly, the reason why they're so confidential is because they know that the things that they say publicly, or the minutes from their previous meetings or their press conferences, can move markets. In fact, when Ben Bernanke was the Fed chair, I think the story is something like he was at a dinner party and said something, sort of off the cuff. And the next day, the market sold off. It was a major mover, but it wasn't like an official statement. I mean, he just said something off the cuff. So that's why they're so, I wouldn't call them secretive, but I would say confidential and measured in their responses, because they can impact the world economy, truly. They buy securities and they deposit the money in the bank's deposit account on the Federal Reserve, right? So that money is created out of thin air. But what people may not realize is that commercial banks play a big role in the money supply of the U.S. economy. And it's all based on a concept we call fractional reserve banking. So remember, reserve is how much a bank has to maintain of a deposit. So they can't lend it out, they can't invest it, they have to hold it. So let's say hypothetically that the reserve requirement is 10%. Well, if a person comes in and they deposit $100,000, the bank has to hold on to $10,000, but the rest of the $90,000 can then be lent. So let's say they take that $90,000 and they, make a small business loan to one of their customers. Well, that money gets deposited in that person's account. Where did that money come from? Well, it came from that fractional system. So they hold 10,000, they lend 90,000. So when that 90,000 gets deposited into account, the bank has to reserve $9,000, but can then lend $81,000 out. And that $81,000 gets deposited, and they have to reserve a portion of it. And that goes on and on and on. And so that is creating money. So it's increasing the money supply of the U.S. economy. And that all happens through this fractional reserve banking system. And so with a $100,000 initial deposit, that actually can support up to $1 million in this example of new money that's created within the economy. So the reason you should care about what the Federal Reserve does is because they can move markets, and not just U.S. markets, but global markets. Essentially, what they're going to do is it will create some volatility within the market. So being aware of the thinking of the Fed, like, do they think the economy is expanding, contracting, inflation up, inflation down? That will give an indication in terms of their actions today, as well as their actions in the upcoming months. And so as an investor, you need to be aware, because remember that every single investable asset class, with the exception of a few, valued using interest rates. Again, interest rates down, valuations go up. Interest rates go higher, valuations come down. And that's the easiest way to think about it. So when you're watching the Fed, you're reading the minutes, you're listening to the press conference, that gives you an indication in terms of what valuations are going to do in the near term, or could potentially do in the near term. Let me put it that way. Remember that the Federal Reserve has one of the biggest impacts on our economy, and it will show up in your 401k or the rate you pay on your mortgage. Thank you for watching, and subscribe for more insights like this.